Ken Shinoda joins us, portfolio manager over at DoubleLine Capital. And Ken, we weren't really expecting to hear a whole lot out of the Fed today, at least in terms of shifts in policy. But when you listen to the tone of the statement and of Jay Powell, are the expectations for rate cuts, at least based on economic conditions, is that still intact?
I think there's a chance for rate cuts, but I don't think it's till later this year. He's pretty happy with where policy is. He mentioned it many times that they're in a good spot, that the balanced risks of the labor market, inflation have kind of come down a bit. So I think they're on hold until the data tells them otherwise, whether the labor market weakens or inflation comes down more.
And I don't mean to be flippant about this, but are they effectively on hold until June 17th and they have a new Fed chair sitting?
It sure seems so. And I think that's what the market's pricing in. Basically, nothing till Powell's term is over, and then maybe at best 2 cuts through the end of the year.
And I'm curious to know what you make of the race for the next Fed chair. It seems like the short list involves, of course, the Kevins, Kevin Warsh, maybe a little bit more than Kevin Hassett, BlackRock executive Rick Rieder, and Christopher Waller dissenting today. I imagine that means he is still in the running. How closely are you watching this from the perspective of a portfolio manager?
I mean, it's just so volatile. I don't know if you look at the poly markets, they're very popular these days. People like betting on everything, up, down, left, right. And Rick Rieder's probabilities recently skyrocketed. He was like sub 10%, I think, towards the end of last year. So I feel like Warsh is a little close to the administration. And so I would put Waller probably as the front runner right now.
Yeah, well, I mean, you take a look at Polymarket, to your point on Reader's odds. I believe he's solidly still in the 40s right now. So, I mean, game planning this a little bit. If we are on hold until we get that June meeting with the new Fed chair in place, you have to imagine that they're going to lower interest rates. When with the expectation that, you know, we will get more cuts, it'll just be a few months delayed here. I mean, how does that translate into what you're doing in the bond markets right now?
Well, if they're not going to cut till, you know, sometime in the second half of the year, floating rate securities that people were worried the coupons were going to drop will earn a little bit more carry. So I think some floaters here are attractive. The bond market's been unusually stable. I mean, it's the 2 years been in less than a 20 basis point trading range. The 10-year oddly is higher in yield since we started cutting again last September, but still it's been in this kind of 4 to 425, 430 trading range. So here, credit markets, spreads are tight, but with earnings strong, I think credit can perform well. So it's kind of an earn your carry market in fixed income this year.
Any concerns, Ken, about some of the moves that we've seen in the dollar, and more importantly, the tone coming out of the White House with regards to what at least appears to be an avocation or at least some comfort with softness in the dollar? I thought Jay Powell kind of brushing that off, saying that's not really the Fed's purview. That's basically the Treasury's decision here. Any concern, any overlap?
You know, we've been talking about adding non-dollar diversification to your both fixed income and equity portfolios for almost a year now, and it didn't really work for a while until maybe middle of last year, and we still think that's a good idea. The dollar remains strong for a long time, but policies in place today, along with continued issuance of debt and fiscal concerns, I think it makes sense for investors to diversify both fixed income and equity portfolios.
Absolutely, and you have to imagine that dollar volatility, really FX volatility in general, will continue, Ken. But I want to go back to the point that you made when it comes to credit markets at this point. You called it sort of an earn your carry type of market. Where can you best do that right now when you take a look across the landscape?
Well, our favorite part of the credit market is probably shorter duration, where you can be at the front end of the curve. You don't have to take that much interest rate risk. You don't have to take much spread duration, which is the sensitivity of a bond to movements and spreads. So shorter duration type assets where you can still pick up, you know, maybe 100, 200 basis points over treasuries. I think that's a nice place to kind of hide out until we get some vol. Hopefully we do get some vol. This has been kind of a boring market. Equities just seem to climb the wall of worry higher, and fixed income just kind of moves sideways. So as an investor, although it can be stressful, we enjoy these times of volatility because that's when you can find opportunities in the marketplace.
All right. Well, be careful what you wish for, Ken. I am curious, though, too, when you look at, particularly in the credit space, are you willing to take on a little bit more risk right now, or do you actually sort of just maintain a little bit more of a safer posture, if you will?
Yeah, the corporate credit markets have gotten very tight, especially high yield. We're approaching 250 spread on an option-adjusted basis, but there's still pockets in that securitized space. So things backed by, non-government guaranteed residential, commercial mortgages, parts of the asset-backed security market where you can still find, I think, high yield type spreads with investment grade ratings. And so that's kind of where we're hiding out right now. We can still pick up kind of the same spreads that you do in double B, single B, high yield, but we've got structural protections in the capital structure, and we've got hard assets underneath those securities.
Ken, always a pleasure. Ken Shinoda, portfolio manager over at DoubleLine Capital.